There are more than 275 million vehicles on the road in the United States.
Buying a car is one of the biggest expense for an American family, second only to probably buying a home. Most Americans use a car loan to buy their cars. However, recent years have seen a surge in car ownership. Car prices and monthly payments on those car loans have been increasing in a rather dramatic fashion. However, Americans continue to originate new auto loans. But there are some worrying signs. According to FDIC 2023 risk review, the early stage past due rate that measures loans that are late by 30 to 89 days has been increasing for auto loans. With the possibility of economic correction or even recession, the conditions are fast approaching crisis level. So are consumers themselves responsible for this situation, or are the car dealers and the banks taking advantage of the situation and using predatory practices that are setting up the loans and the consumer up for failure? Let's explore and examine cause and effect illustrated through 4 facts of car loan environment if today is America. Constantly rising prices, negative equity, aggressive borrowing, and rising delinquency. We'll talk about each of these, but let's first understand how big of a problem this auto loan issue has become.
More than 100 million Americans have an auto loan, and auto loan debt in the US is currently at $1.5 trillion.
The problem of auto loans has grown, particularly among young Americans, ever since the COVID-19 pandemic. This is especially true for Gen Z and millennials. The Federal Reserve believes may have borrowed more than they can handle. The financial strain on the consumer is becoming apparent as more and more consumers are falling behind on their credit card and auto loan payments. US consumer credit card debt crossed $1 trillion for the first time last quarter, according to the Fed data. And according to TransUnion, the unsecured personal debt has risen to $225 billion in 2023. And on a nationwide scale, America's government borrowing has ballooned to $33 trillion. It has experts such as Ray Dalio warning that it could be start of a full-blown debt crisis. So it's a real big problem. How did we get here? Back to my 4 facts. First, rising car prices.
Years ago, shoppers looking for an inexpensive car could choose from about a dozen models selling for less than $20,000. Now, there's only one.
The average price of a new car in the United States has been steadily increasing in recent years. This trend that was already existing got a boost by the COVID-19 pandemic, which caused a disruption in the supply chain and hence reduced the supply of new cars. As a result, car prices have reached new high and many consumers are struggling to afford these car prices. According to KBB, in 2022, the average price of a new car was $48,681. This was $2,250 higher than just a year ago. Everyone who bought a car during and after the pandemic years knows that they overpaid for their car. As car prices rose, so did the debt that Americans took to finance their car. And there are many factors causing this rise in car prices. First is reduced supply. As I just said, COVID-19 caused a disruption in supply chain, and this was due to a number of factors, including factory shutdowns, port congestion, and reduced supply of semiconductors.
The semiconductor shortage was one of the contributing factors to all of the empty dealer lots.
Next is increased demand. All the shortages over the past few years led to a pent-up demand for new cars, but the input costs have been rising. See, inflation has been on the rise in recent months and years. So this has driven up the prices of not just gas and groceries, but also cars and their input materials. Next is rising interest rate. The Federal Reserve has done many interest rate hikes in an effort to contain inflation, which in turn is making it even more difficult for the borrowers to afford their monthly car payments. This trend of rising car prices is having a tremendous effect on the consumers. Many consumers are finding it very difficult to afford the car that they want. So some of them are even postponing their purchases. This eventually is leading to decline in new car sales. The next major factor is the negative equity. According to data from Edmunds.com, the average negative equity on a car brought for trade-in reached to $5,341 in Q4 of 2022, which is a 29% year-on-year increase. The number of vehicles involved in trade-ins that have negative equity also rose by 17% during the same one-year period. So what exactly is that negative equity on a car? Negative equity is when the amount owed on a vehicle, the loan amount, is more than the value of the vehicle. So for an example, if a person still owes $25,000 on his car, but the car has now depreciated and its market value is just $20,000, then the car has a $5,000 worth of negative equity, also known as being underwater on a loan. Negative financial equity is a risky situation for a borrower to be in. These trends are causing concern in both automotive and financial industries. A sharp and substantial increase in negative equity can place many borrowers in financial hardship. This may cause more defaults, with potential ripple effects across the financial sector. The next major factor is aggressive borrowing. In this chart, we observe expansion of outstanding car loans from the beginning of pandemic, which is about Q2 of 2020, to Q4 of 2022. According to Federal Reserve, the average loan now stands at $24,000, representing a 41% increase from the 2019 levels of $17,000. And this substantial rise can be attributed to many factors, but the end result is that Americans, particularly under 40, have substantially increased their debt levels, particularly vehicle-related debts. Back to the chart. While it's expected for Gen Z, like around 26 years age, to exhibit higher growth levels, at 31%, their loan growth levels is much substantial than all other age groups. And what has allowed this risky consumer behavior of borrowing above their means? First, easy credit. In the years leading up to this crisis, the lenders were eager to lend more and more to more borrowers, even those with poor credit. This was in part due to this concept of securitization of auto loan by creating what is known as ABS, asset-based security. ABS are a type of financial instruments that are secured by assets like car loans that typically generate some regular cash flow, like the monthly car payment. Auto loans-based ABS allowed lenders to package a lot of smaller loans, different quality loans, as a package and sell them to folks on the Wall Street to invest in. And looking at the whole package, rating agencies typically categorize them as safe investment. No surprises there, as the same agencies completely missed the 2008 subprime crisis as well. Now again, lenders sold bonds containing $76 billion in subprime loans in 2021 and 22. All of this was of course predicated that majority of these auto loan borrowers will continue to make their monthly payments. But because of this ABS, many more borrowers were able to qualify for a car loan, which otherwise they would not have gotten. Now, with more and more borrowers falling behind on their monthly payments, there is a risk that the ABS bondholders may start losing money on their investments. A second reason behind these auto loans growing at this higher rate is predatory lending. Some lenders frankly resorted to predatory lending practices, and dealers typically make money on such loans through other means, like very high fee and interest rate, or selling them unneeded extra services. These type of loans typically have a mandatory arbitration clause that essentially waives the consumer's right to sue and appeal in a court of law. This has frankly, as expected, led to higher rate of delinquencies and default on these loans. That brings us to the final factor, rising delinquencies. Auto loans typically come with fixed rates, which allowed young Americans in particular to benefit from the low rates that were prevailing during pandemic times. However, because of high car prices, a significant number of Gen Z individuals, 1 in 5, reveal that car payments alone constitute about 20% of their take-home pay. So what does this mean? It unfortunately means that the younger drivers are getting delinquent and behind on their auto loan payments at a much faster rate than their older peers. In the course of 2022, Gen Z and millennial experienced a collective $20 billion in auto debt falling behind for more than 90 days. The consequence of these developments is that major lenders like the Fifth Third Bank, US Bank, Citizen Bank, or Capital One are increasingly declining applications for car loans, as reported by US Today and Federal Data. The Federal Reserve reported that the rejection rate for auto loans has risen to 14.1% in June from where it was about 9% in February. The Fed also reported that the average likelihood of an application being rejected has risen to about 30%. That's the highest level since such data started being reported since 2013. So what can a car buyer do? Are you in the market for a new or used car? You can do yourself a big favor by coming to the negotiation table armed with a fixed budget that takes into account both interest rate and the monthly payment, and stick to your budget during the full buying process. With recent surge in interest rate, some buyers may be tempted to extend the term of their loan to lower their monthly car payment. However, exercise maximum caution because this can lead to that negative equity situation. Also, shop around and talk to various lenders to find the best deal. Don't be lazy and just settle for the financing option being offered by the car dealer. I also recommend considering more affordable vehicle option. And remember, drive below your means. If you enjoyed this video, check out this other video about choosing between buying old car versus new car. I would also appreciate if you can give a like to this video and subscribe to the channel. Thank you.